What's your take on gold and silver?
Massive, massive bull. We've broken out of the long-term big picture charts. We've got a 50-year or 40, 50-year cup and handle pattern on silver. We've broken the downtrend line to the upside. We've been consolidating and falling wedges on both gold and silver. And I think that given certain market conditions that we are in and are coming, I think we have a big upside.
Hey, Andy, thanks for coming back on the show, man.
Yeah, thanks for having me. Really
Let's
appreciate
just,
it.
yeah, 100%. Well, let's just dive right in. What is your overview of the economy at the moment? What do you think is going on out there?
Tough read. Tough read. So this is what I see. Home sales are slowing down. We're seeing the housing starts kind of dip. We're at like 1.2 million versus before about 1.4 million. We're not at critical levels where it's in the bag recession yet, but we do have a little bit of a slowdown in the housing market. That's definite. Sales are definitely down. No disputing that. But that's not what drives the economy necessarily. It's generally construction jobs, employment in construction, housing starts, which is the volume of credit coming into the system. That's kind of what drives everything. Home sales have definitely slowed, and we're seeing the housing market slow a little bit in terms of housing starts. Could be considered a mid-cycle wobble in the real estate cycle. And the way that that kind of works, just to kind of throw it out there real quick, you get an inflationary impulse kind of move into the system. Interest rates follow that inflationary impulse move, and then you start to see things slow down. That's what generally leads to a mid-cycle wobble. Then they lower interest rates when things start to slow down, and it reignites the housing market again after that kind of slowdown in the economy as it digests those higher rates. Right now, what's difficult to gauge is the economy slowing or is it speeding up at this exact moment? Is the slowdown behind us or is it still ahead of us? What does all that look like? That is like the difficult part to know exactly where you're located. All I can say is rates are high. They've been high for a while. There are some indicators that are slowing down that could push us into a further slowdown. And then there's some indicators like manufacturing around the world, global manufacturing indexes and stuff that looks like they're starting to come back up, and liquidity. You throw this fiscal spending on top of everything, and that kind of muddies the entire water. We've got an inverted yield curve that is starting to, it looks like it's trying to uninvert, but at the same time, that uninversion is occurring with interest rates going up, not down. So there's a lot of things that make this read a difficult one. But there's things I would say it's difficult to say if we're slowing down or if we're going to recover here. Generally speaking, if you were to look at history, inverted yield curve, it uninverts when the yields come back, and that's generally when a slowdown occurs. That's historically what has occurred. And during those market conditions, it's beneficial to be in certain assets versus other assets. And when you look and you dive into the charts to see, are we going to get a recession? Does that match some of the charting in some of the, companies and areas? Doesn't match it yet. So that's what makes it difficult. It's like, are we going to get one? Are we not? Are they going to lower interest rates? Are rates going to break to the upside? And right now, that's all in limbo. So, and I can use charting and show you guys what that looks like if you're interested, but that's kind of what I see at the moment.
Right. Before we go a little deeper, I just want to remind the audience, be sure to hit that subscribe button if you're enjoying this interview. 88% of you guys who watch this content are still unsubscribed. Let's go ahead and flip that ratio around. Help me out a little bit here. Let's get the algorithm boosted here for a bit. Hit that subscribe button, like the video. Andy, follow-up question. You mentioned rates being higher. You're also seeing yields spiking higher as well. What does that portend to? What's going on with yields?
Yeah, so if the long end of the curve is going up, that's like your 10-year yield. Generally, that is the market putting in higher inflation expectations out in the future. It's called a bear steepener if the shorter end of the curve, the 2-year yield, if it stays kind of anchored and then your long end starts going up like this, that's an uninversion of the yield curve. It's the yield curve's normalizing, but it's doing it with rates going up. And with the rates going up on the long end, that is generally an indication that the market thinks that inflation is going to be here longer, and inflation expectations are changing out in the future. So that's what I think the increase of interest rates going up out in the future is kind of perhaps normalizing to some extent. So maybe the short end stays where it is and the long end comes up to normalize the curve to some degree. During slowdowns, what you see with interest rates generally is they fall, and the short end falls faster than the longer end. So your 2-year yield, think of it as the banking system having insider information of what the Federal Reserve is going to do, because the Fed is basically the banks. The banks load, they put money into the shorter end of the curve because they know that the Federal Reserve is going to lower rates, and they front run it. So what you do when you look at technical analysis is you say, okay, I'm going to watch the 2-year yield. We'll watch the yield curve. If it uninverts with the 2-year dropping like a rock, that's generally indicative of rates coming down and a potential slowdown in the economy, because they see all the loans in the system, they see defaults, they see foreclosures. That's all on the bank's balance sheet, and they all kind of just front run that whole move. So we don't see that at this time, not yet. And that's where I'm like, is a slowdown coming? Like, what's going on here? Are we going to hold rates steady? They could be doing things behind the scenes. We've seen the M2 money supply increase, and we've seen the reverse repo money go up too. Makes me think that they're doing QE, but holding rates at the same spot. Like they don't want the dollar to fall, and they're just holding it all together. So I think there's things behind the scene going on that Powell's doing, that they're trying to manipulate the market to some large extent by keeping the dollar stronger, perhaps, and rates at a steady level, but also doing QE in the background is my guess is kind of what they're doing.
Gotcha. Well, let's go ahead and
Mhm.
dive right into gold and silver. The gold and silver prices have been acting very interestingly enough. Gold's been making all-time highs in and out,
Mhm.
just about at 23 and 2,300 and some change now. Silver just under $30. It seems like anytime it gets above that $30, that pesky $30 range, it gets slammed back down. What's your take on gold and silver?
Massive, massive bull. We've broken out of the long-term big picture charts. We've got a 50-year or 40, 50-year cup and handle pattern on silver. We've broken the downtrend line to the upside. We've been consolidating and falling wedges on both gold and silver. And I think that given certain market conditions that we are in and are coming, I think we have a big upside for gold and silver. So I'm not a short-term trader. I don't try to time the small little movements on a day-to-day or week-to-week basis. I look at the big picture view and say, where could this potentially go, and how big could that potential return be? And then I position for it, much like playing chess. I'm not trying to win every single piece, and some pieces might be sacrificed on the board to win the game. That's kind of how I play it. I'm not trying to make money on every single short-term movement. I'm trying to make the big move and win the game in the end. So I position for the big end of game win. And when I look at the big picture view on gold and silver, they look absolutely fantastic. In an increasing interest rate environment, very similar to the 40s all the way into the 70s, that's when silver did absolutely phenomenal. Same with gold. And we're talking about the physical metals making moves of 25x, 23x for gold, and silver doing a 50x. Is that not a large enough return just to buy the physical metal and hold on to it for the bull market? I think it is. So that's my viewpoint. So looking at the 50-year cup and handle and that breakout in silver, I'm in and I'm just going to ride it. I'm not going to try to time the short-term market movements. Some people will call me a perma bull because I'm going to take the long-term view and be bullish the entire time on it. And I'm okay with that. And I think they both look fantastic. So if it were me, I'd take a long-term approach, look at the big picture view, big picture charts. And I think they both look absolutely wonderful.
So I had Trader Ferg come on a couple of days ago, and he was basically saying how the gold and silver story seems great. The thesis sounds great, um, but how do you play it? Outside of the physical metal, given that mining stocks are oftentimes considered a lottery ticket. What is kind of like your strategy there to play the precious metals bull market? Do you look at mining stocks? Do you just stick to the physical? What do you say?
Well, what I've done is if you look at how to position size some of this stuff, and that's kind of how I view it, is how do you position size it and play an idea? If the physical metal returns 23x back in the 70s, and same with silver returning such large amounts, 50x or so, I want to have max exposure to the highest probability of success with the least amount of risk. That is your risk reward setup. So your risk reward setup, I think, is greatest times your probability in the physical metal itself. So the physical metals, I own a very big chunk of my original money that I put into it. That's where I put the majority of my money. And that's physical gold, silver, and I like platinum too for a variety of different reasons. And then I would also include mining companies, and they haven't been successful for a pretty long time in terms of returns. They've been pretty abysmal. But I also think that's why what gives you an advantage is buying it at such a low ratio. So gold and silver mining companies in relationship to gold are at like all-time lows going way back. So they're very cheap. And we've been in this 40-year declining interest rate environment, which I think hasn't been that great for the mining companies. The conditions have not favored the mining companies. And with the breakout of the 40-year downtrend in interest rates to the upside, I think we could see an environment where gold and silver outpaces the input costs, and some of the miners could do incredibly well. So I would have some allocation to gold and silver mining companies, and that allocation wouldn't be nearly as big as the physical allocation. That's the way that I would play it, but I would have some allocation to it. And the ratios suggest that silver junior companies are probably the cheapest of all of them, but they also possess the greatest amount of risk. So that's what you have to balance. And the way that I would position size this is what is your probability of success? What is the potential asymmetry that you're seeing to the upside for returns? And how much risk are you interjecting into it? And then you could almost come up with a formula, I guess, where you multiply it all together and then you can position size it. Your position size is determinant on where you're buying it too. So if you're buying something at a very cheap, like complete out of favor price, you can overweight it more than say something that's run a whole bunch and could be towards an end of a bull market, something like Nvidia or some of these tech stocks that have had monster runs that are overpriced. So position, I know I'm going into position sizing because a lot of people ask me about position sizing. If something's cheap, you have a good risk reward with a high probability, overweight it. If something is very cheap, but the symmetry is so lopsided where you could have just huge upside returns, like 100x plus, I would have some allocation to it depending on what the risk looks like. And if you have a real good entry point, that's when you take it. If there's a unicorn setup, I'll call the unicorn setup, a unicorn setup, which could exist in the miners here, where you get this big bear market for a long time. You get an ideal setup. I call it confluence of information that all aligns together, where the metal is cheap against all the other assets. The miners are cheap against the metal that's cheap against all the other assets. And then you're coming into a market condition where it comes into favor for these assets where money's going to rotate into them. I think that is coming for gold and silver. And I would allocate some money to the mining companies, irrespective of how unfavorable they've been these past 40 years. I would have some allocation because you don't need to ramp it all the way up and put 50% of your portfolio in it. You just need a small amount because the symmetry will carry you up. So it's kind of like, how much money do I need to put into it to make a difference in my life? And maybe that only is 3 or 4 or 5% of your portfolio allocation. So that's the
Right.
way that I view it. And I think that the mining companies are so asymmetric that I would have some allocation to it.
Right, right. And so when it comes to physical metals, we use Miles Franklin here at this channel. Looked all over the internet. I've tried to get you guys the best deals. If you email them at info@milesfranklin.com and tell them that Capital Cosm sent me in the description or in the subject line, you'll get their special pricing guide. Honestly, I couldn't find any more competitive pricing out there for you guys. There might be. I just may not be aware of it. So give it a shot. Email them at info@milesfranklin. See what you get. Andy, I want to ask you though, do you stack gold and silver though? Do you stack it for as a form of insurance, or do you see a day where you will actually sell your gold and silver? And if so, what would an exit look like? What are some of the key points? Like if you had a checklist, how would that checklist look like for you to determine whether it's a good time to sell your gold and silver?
Yeah, so right now I don't sell any of my gold and silver. I don't view it necessarily as only insurance either. There's times in history where financial assets are in favor and then hard assets are in favor for different times in history. I think that we're seeing a rotation of financial assets to hard assets. And I think we can increase the purchasing power of financial assets owning hard assets like gold, silver, platinum, palladium, whatever it is. So I don't see any reason to buy some of these financial products like bonds when I would rather own hard assets. And I think hard assets will actually appreciate in purchasing power against those financial assets. So that's number one. I know they're cheap. And if I can buy the insurance aspect of it and I can get purchasing power increases and the probability of success is incredibly high, that's when you pile in. So that's what I've done is I've piled into the physical stuff because of the situation of where we're located on the I'll call it where financial assets are expensive and hard assets are cheap. So where we're located in history. I wouldn't have done this in 82 or 83. I would have bought a whole bunch of stocks. And in 2000, that's when hard assets came into favor and we're still in favor. We're putting in another, I'll call it a double bottom against the S&P 500 and all these other financial assets. So I view it as a way to increase purchasing power with the least amount of risk. So that is how I do it. And then furthermore, you can also play the ratio game. So you can overweight certain precious metals and then swap them between the precious metals because they don't all perform exactly the same in the same conditions, market conditions. And you can increase dramatically your ounces of holdings by swapping metals back and forth given certain ratios. Right now, I think platinum looks pretty enticing, and I think silver does. So silver and platinum are two that I think look really good from a longer term ratio perspective. And gold's more of a monetary metal, so you can own that one too. And then you can swap back and forth, increasing your ounces. I had swapped palladium. I owned a lot of palladium from a while back. I swapped it all to platinum in April of 2020, and I've already, by looking at the ratio move, I've already done about a 3x in my quote palladium holdings, given how platinum's outperformed palladium. So that is a 3x in metal holdings. I haven't swapped it over. I'm just saying it would hypothetically be almost a 3x in holdings.
Can you explain the platinum story? What is the thesis behind platinum?
So, I mean, I'll just go back from a ratio perspective, and then I can talk about platinum,
Sure.
perhaps. Um, Looking backwards in the ratios, I'm just going to start there. Whenever you're cheap against all the other metals, platinum's cheap against palladium, it's cheap against gold, and it's cheap against silver at this time. So silver's not the cheapest asset; it's actually platinum. Natural gas being arguably the cheapest of all of them for commodities. But when you get these periods where an asset is really cheap against everything, generally, if you buy it, you do incredibly well if you can hold it and you've got a long enough time frame and holding period. That occurred in palladium in the 2009 era. It occurred in rhodium in 2016, and it occurred in silver in various areas throughout history. Like 2000 was a good time, and the ratios were all cheap. So if you bought silver in 2000, you made a buttload of money. If you bought palladium in 2009, you made it like an absolute killing, like 30x your money in terms of dollar terms. Rhodium went from $600 all the way to almost $30,000 from 2016, the bottom upward. And platinum is in the same exact situation as those metals in history at this time right now. So from a ratio perspective, that's what it looks like. From a economic perspective, whenever something gets cheap against other assets, like platinum is cheap against palladium, you get substitution. So people like my previous life, I'll call it engineering, we figure out ways to adopt the cheapest materials into something. So if something's cheaper in platinum, the ratios are a way to tell if something's cheap or expensive on a relative basis. Engineers will come in and start engineering that material into everything because it's cheaper. They'll substitute it. There's a lot of substitution that occurred with new cars being built in their catalytic converters where platinum was substituting palladium. And then for a period of time when those cars are produced, they'll use platinum instead of palladium in those catalytic converters. And then the demand for platinum goes up, the demand for palladium goes down, and then you get your bull market in platinum. So I think that catalytic converter use is going to go up in the future, probably all the way into the 2030s, maybe even 2040s. I think it's also a bet that electric vehicles may not be the answer to everything. There's a variety of reasons why electric vehicles, battery electric vehicles, may not take over the world in terms of mineral constraints, in terms of ease of use, in terms of people parking their cars outside of the garage and not being able to charge them. There's a whole bunch of different reasons. I think hybrids are a better solution, and they require larger, I'll say larger loadings of rhodium, palladium, and or platinum in their catalytic converters because they don't run as hot. So I think the future will be more hybrid based than it will be battery electric vehicle for a variety of reasons. And those reasons could include everything is transferring to electricity, it seems like. I think there's going to be constraints on the grid itself, and the power generation to provide power to the grid. Right now, everything is kind of dumping onto the grid, and I don't know if it can handle it. So the constraints of power generation and the grid itself is going to lead to people wanting a more an easier solution where they may go and buy a hybrid and or an ICE vehicle, internal combustion engine vehicle. The battery electric vehicles also, I think there's going to be constraints potentially in some of the minerals, copper specifically, which could also constrain the transmission of power and stuff like that. So I think there's constraints too that can slow down the growth of battery electric vehicles and a lot of these other vehicles. And Toyota agrees with that. That's kind of where I grabbed some of this information was from Toyota directly. Toyota is more jumping on the bandwagon of hybrids, and I think that's probably the correct call. And that's kind of where my opinions and my viewpoint and paradigm comes from. We also have hydrogen, and if we go the hydrogen route, that uses platinum for a lot of their catalysts and stuff. Not catalysts, but their it's in their fuel cells. So platinum's used in fuel cells. If we go that route, and I'm not saying that we're going to go that route, but if we do, um, platinum would benefit from going that route. And I don't think there's enough platinum to do both of these things, like to provide all of it to the catalytic converters and also to do this hydrogen world if that does materialize.
Okay, so in my most recent interview with Rick Roll, I asked him the question, what he sees as his most asymmetric sector right now. As in, what sector out there has the most potential upside? And he said lithium, and then followed by
Mm-hmm.
nickel, but not for probably another year or two. Link to that interview is down below, guys, if you want to check it out. But do you have that same sentiment about lithium? Essentially, Rick said that lithium is in the same place uranium was a couple years ago, i.e., before uranium had its big rise from $30 to all the way up to north of 100 earlier this year. So, what do you think about lithium?
Well, I mean, it's had a huge pullback. I don't know as much about lithium. I'm a little bit more afraid of lithium because if it lithium goes into batteries, that's mainly where it is, and I'm sure there's going to be a lot of technological development in the batteries themselves. So, I mean, lithium could be great today and be gone tomorrow if they figure out ways to other ways to put into cars and all these things. So I'm not a huge lithium bull, and maybe it turns out to be the most asymmetric play, and it turns out to be a huge great investment. I just don't know as much about lithium than maybe Rick or some of these other guys do. I look at the charts. The charts look okay. They don't look great um, from a charting perspective, and I just look at and use them for entry points in a long term view. I would say uh, from an asymmetric viewpoint, natural gas is a better play than lithium. We know it works. It's got a good energy return on investment. We know that we've basically converted all of our power plants from coal to natural gas in America. Natural gas is the largest baseload producer of electricity in the United States. It'll probably be one of the largest in the world at some point. We are massively piling it on in terms of natural gas power generation. So I think something like natural gas at this point is probably one of the largest asymmetric bets. If you price it in terms of an asset versus an asset and do all the ratios, natural gas comes out as usually one of the cheapest out there. So I think if it were me, I know natural gas better than I know lithium, and I know some people are pretty negative on natural gas at the moment. The sentiment is definitely not there. So I think natural gas could be one of the largest asymmetric bets out there, but lithium could be too. I'm not denying that it's not. It is down and it has fallen quite a bit. So I'm not saying it's not. I just don't know it as well, and I don't know the companies as well. I've looked at a lot of companies chart wise, but none of them scream to me that I should be in it at this moment.
Gotcha. Well, the natural gas companies, while the natural gas futures may have dipped quite a bit, the companies themselves haven't really traced the move down to natural
Mhm.
gas. Uh, would you still play natural gas through these companies, even though they haven't really traced the downward descent down in the same way that natural gas has? In the sense that is there as much upside um, in these companies as it appears to be in the futures price. So the futures price went all the way down from $10, that's Henry Hub, all the way down to I think it's like 275 now, but it reached below that $2 level a month back or so ago. So you clearly see the asymmetry there. But the question is that same asymmetry there for the companies? What do you think?
So there's multiple companies that you can invest in to play this. You've got the natural gas equities where they produce natural gas, and then you've got the energy service companies. The energy service companies, if you look at the rig counts are way, way down. So I think there's a lot of opportunity for expansion of natural gas drilling through the energy service and drilling companies. So there's huge symmetry there where they are way out of favor, no one looking at them, and they're coming off bottoms. So there's gigantic symmetry there. That's how I would play it. And what you look for in the drilling companies, this is onshore drilling, because I know they're all about the offshore drilling companies, and I am too. It's just no one really cares about onshore drilling at all, which makes it more enticing to me. Their argument for offshore is that they're not going to be able to build any of these offshore rigs that we've got, or drill ships, and that's a moat around it. And I would say that's exactly right. I'll take that. And my question then would be, well, where's all the growth going to occur from? If it's not coming from offshore because you can't build it, well, where's it going to come from? These onshore guys, no one gives a crap about the onshore guys. And I'm like, well, that's where all your drilling is going to come from, probably. If you can't drill offshore, you're going to drill it onshore at some point. So I think there's a lot of onshore drilling that's going to occur. There's definitely, I think, a lot up in Canada, and there's a lot of opportunities for onshore drilling in Canada in specific locations where I think we will still have exportable capacity of either natural gas or oil. And I think drilling with where they're located is in a really cheap location, incredibly cheap, huge asymmetry there. So you can play it not just through the natural gas equities, which I still think are good, but I think the energy service companies are also incredibly good.
Gotcha. Well, you mentioned uranium earlier in the interview. Let's talk about uranium. Is uranium out of season right now? We're in the summer doldrums, as it may be. Seasonality speaking, uranium kind of takes a break during the summer. Is that the case this year, or is there something more to the story? What's going on with uranium?
Yeah, uranium's kind of just been it's pulled back, it's consolidating. But we've had I call it a lead-in pattern. We busted out of that base. It consolidated for a good chunk of time. I know a lot of people probably jumped in 2021 chasing the price movements. It consolidated all the way out to 2023. And then we've broken out of that consolidation to the upside. So we are in an upward break, but we're just consolidating downward sideways here recently. So I'm still incredibly bullish on the longer term for uranium, but we've just been slow. We've just been consolidating here for some many months, and people get frustrated. They get impatient, and all I can say is the bull market's still there. It's alive and well, and some year symmetry has come off. I mean, we're not. This isn't 2020 or 2023, even 2022, 23, where we were bottoming there. So some of the symmetry came off, but I think longer term, it's still intact, still in play. And short term wise, it's still consolidating at this time, unfortunately.
Gotcha. Well, are there any charts you want to share with us, Andy? Any ratios you want to share with us that you think are particularly interesting that should be on the radar screen of the average retail investor?
Yeah, yeah. So here's something. I've got the dollar pulled up here, but a lot of these rates they've just been consolidating here. You can see these consolidations, this
Yep.
whole consolidation. It's important to know if this is going to break to the upside or if it's going to break to the downside. Um, if we get a slowdown in the market, you're going to see the 2-year yield drop like a rock, and it's going to fall. And there's going to be certain assets that do very well during that fall. So if it falls, what I would be looking at is gold and silver are most likely going to rip. That's the uninversion of the yield curve. We get a slowdown in the market, yields drop, and that's going to push, I think, gold and silver much higher. And you can also gauge this looking at gold and silver as well. Right now, when looking at this chart, it hasn't broken out of that consolidation, and it still looks bullish for a move higher, unfortunately. So to me, this is something that you want to watch, right, is the 2-year and 10-year yields. Yields price the entire market. When yields go up and the rate of change is really great, that generally puts a downward pressure on the S&P 500 and a downward pressure on NASDAQ and stuff like that. But we've been consolidating sideways which hasn't been putting that pressure on the markets. If this does break to the upside, it's going to put further pressure on the markets. If it breaks to the downside, it could mean and put also pressure on the market that there's a slowdown in the market. But gold and silver generally do well when that yield curve uninverts. Oil does well and is usually a driver if this is breaking to the upside. So when I look at these things, I'm trying to get all of the information and piece together this puzzle using charting and looking at drivers of asset rotation. And right now, we're kind of just consolidating in the 2-year, here's the 10-year, we're consolidating sideways into what is going to be becoming a decision point. If a slowdown occurs, you'll see it probably dive down. If we get a inflationary outcome or outlook, rates are going to break to the upside. I can't tell you which way this is going to break yet. I'm waiting for that break and to see what the market thinks. The market is the determining factor of all this stuff. It's not an opinion from an expert. It's not opinions that are aggregated over whatever. It's the market and the way that the market is positioning that you should be gauging your decisions from. And the 10-year yield and 2-year and all of these things is telling us where we're at in the business cycle, where we're at in AKA the real estate cycle. It's the same thing. And I still think that there's real estate cycle is still, there's a big boom ahead of us still because we are still short. I think credit is still going to expand. And we may need lower rates for that to occur. And maybe we get a slowdown before that occurs. And then we go into the last phase. Another thing to think about is the dollar rates and the dollar, from what I have seen, pretty highly correlated. It's not always that way in history, but they've seemed to be pretty correlated. I think that the dollar will get weaker when the rates on this drop. So we could see rates drop, dollar drop. And one thing that people I don't think are aware of, and this is uranium investors, oil investors, gold and silver investors, they think everything is supply demand, supply demand, supply demand, supply demand. You know, you also need to look at the denominator. What are you pricing this in? Gold is a ratio. It's gold priced in dollars. And the dollar falling is going to be a catalyst potentially for commodities to go higher. So I can't say that we're for surely going to get a weaker dollar because that's dependent on other currencies being, stronger. And that's generally the interest rates being steady in other currencies while ours drop against it.
Right.
Because it's all relative. But if we get a dollar to weaken, that will also be a tailwind behind our commodity investments and precious metal investments. And I don't think a lot of people watch that. So that's something else to watch. This is XAU. This is your gold and silver mining companies in relationship to gold. Last bull market, basically it started in about 98, 99, where that X is, maybe somewhere in this region there. When we went through that bull market, the gold and silver mining companies went down all the way till 2011. So we went from a high point to a low point where gold, the physical metal, actually outperformed the gold and silver mining companies. What I am hoping, and again, I don't know the future, I am hoping that this is a downward move, a bottom, and then we break and move higher where gold and silver mining companies outperform gold itself with gold moving up. So that is one large difference that people may not be looking at this time, where gold and silver mining companies could outperform gold based off of this ratio and how it is performing versus history. One of the differences between this condition here and the condition that's coming is interest rates. So if you look at the 10-year interest rate, I think this is the driver of it. So last bull market for gold and silver, we had a huge move higher. during this time frame here, and the miners also outperformed under an increasing interest rate environment. If you look, last environment, we were in a declining interest rate environment during that commodity bull market. Today, we've broken through that downtrend line, and I think that if we continue upward on the bigger, longer picture, that the gold and silver mining companies could outperform during that market condition. That's a possibility because it's very similar to the market conditions back here. So those are some information there. I also want to pull up a picture here. I grabbed this from Twitter just to show you something here. So this is the long-term pricing of silver. And this is a big chart. You can see that silver declined from the 1900s. It bottomed in about 1930s. And then we had a second kind of nice little, this is the lead-in pattern I look for in 1941. And then we had a huge bull market all the way till about 1980. And then we had a big consolidation. This is a big cup and a big handle. And we've broken through this downtrend line coming through there.
And just an FYI, guys, this is a logarithmic scale. So the movements are a lot more pronounced when you look at this in linear terms.
So when I look at this, that's silver in the long term. Look at interest rates that are behind us. Interest rates bottomed in 1941 here. 1941 is this section here. And then we had a large interest rate move all the way till 1981. That is, oops. That is the big, let me do this, let me get this rid of here. That's the big move there in silver. So silver and interest rates move together in that big bull market. And what do we have coming up? Well, we've got that big consolidation, the cup and handle consolidation that we've broken to the upside. And we have interest rates breaking to the upside too, just like the early 1940s that I'm showing you in this potential bottom. So I think when looking at this, I think when you look at an increasing interest rate environment, potentially stagflation could be an outcome too, where we get a contraction in GDP at the same time that we get this inflationary move because of the debt in America. I think it's possible that gold and silver do absolutely incredible things. And I would not be overlooking this correlation and the setup here. When you look at this and you have a cup and handle, so I just want to describe it really quick. Chart patterns are an extension of the psychology of humans trading together in a herd. And they hit these resistance levels wherever they set, the herd sets the resistance levels. It hits the resistance level, and then you have a lower, weaker bounce than before. The bigger the pattern, generally the bigger the move on a breakout. This is probably one of the largest patterns I've ever seen in my life. There's a bunch of large patterns in commodities right now, but this is one of the biggest ones. The projected move is the size of the top of the cup to the bottom of the cup, and then you project it on top of that, basically where we're at. And that is your projected move. Your projected move for silver is multi-hundreds. So 350, 400, $500. It depends on the sentiment and the emotions that people get that changes that money to rotate into it. Will ultimately determine how far we go. So when I see this, I see the correlation of interest rates and silver. I see the cup and handle pattern. I see the cup or the handle breaking to the upside. We haven't broken the top of it yet. We are right at the top of this cloud. And usually when you get above these clouds, notice when you get above the clouds, you get these big rips. There's a big rip here. We got above the cloud here, big rip. I think something big is coming. And the setup looks just like all the other setups in history. So I have to be very bullish on it because of that. And if we rip above this, that activates the bigger pattern too, saying we've broken out of that cup and handle pattern. And then you're going to get a bunch of the FOMO people are going to start running into this. The fear of missing out, they're going to chase price, performance, all of that's going to come and fuel the bull market. So I grabbed this from Twitter. This is not my chart. This is Stoic Silver Bear. If you guys want to know where I grabbed this from, and it looks absolutely beautiful from a charting perspective for this playing
Wow.
out. So that's one of the stuff. Another thing that I find kind of interesting. I just want to go over it real quick. This is crude oil divided by gold. So this is crude oil divided by gold. This is the chart for crude oil versus gold. So we got the awesome setup in silver. We have an awesome setup in gold as well. It mimics the silver setup. But crude oil, we've got this outperformance of crude oil over history from the 80s all the way up to the top of 2008. But one thing that's real interesting here is we've got a declining wedge that we've broken out in 2021. This is a ratio of gold to oil, or crude oil to gold. But look at what we've got here. We've got this another basic breakout here, which is very interesting. Is crude oil going to outperform gold here going forward? That's one of the questions that I have. It's like, what's going on here? We've got a nice little breakout, and we have a long, long runway to work to go up. And maybe we've got a huge move in crude oil coming right in front of us, which is going to push interest rates to the upside. And the setup in interest rates very well could break to the upside, not the downside. And again, guys, I don't know the path. I just know that this is cheap and it's showing breakouts to the upside. And you can also look at crude oil priced in other things. So that's crude oil without my stuff on it. And I kind of just look at all these ratios. This is crude oil versus Dow Jones Industrial Average, which is also setting up for a potential breakout to the upside. So I think crude oil looks absolutely excellent as well from a lot of the ratios that I look at. That could also be another one that breaks. So just to kind of sum this all up real quick, I don't put all my money on just technical analysis. I don't put it all on one thing or the other. I look for a confluence of things to align. I look for a cheap valuation. I look for the equities to be cheap to the underlying commodity. And then I look for a positive movement, like it's coming out of the base to come into a positive inflection point where it starts to outperform. I aggregate the portfolio of all of these setups, and I maybe have 6 or 7 or 8 different ideas, and then I invest in all of those ideas based off of what I think could potentially come in the markets, and the valuations are all favorable for me. So then it becomes a waiting game. It's like, okay, it looks favorable. It's starting to break. I'll take my positions at very low entry points. I position size it accordingly to where my bullishness is, where the ratio is located, how cheap it is, and the symmetry that I've got to the upside. So the risk reward determines my portfolio allocation size. And then I position this portfolio in 6 or 7 different ideas. The symmetries are so big in these ideas that you could make all this money if only 1 or 2 of the ideas work. You don't need all 6, 7, or 8 of them to work. So I know a lot of people, they get very bullish on a certain sector. They put all their money on one sector. Concentration can definitely make you wealthy if it works, but it can also hurt you quite bad if it doesn't work and it goes in the opposite direction. So you're opening yourself up to only one idea, and it may or may not work in the time frames that you want. And what I do is I try to balance the portfolio with 6, 7, 8 different ideas. You buy these different ideas. Some of them you can play it in a way where you get these large dividend yields, even at the bottoms of these markets. And then as it goes up, you get equity appreciation and dividend appreciation on top of it. So if you're early, it's like, it's no big deal. I can collect a 15, 16, 20% dividend yield, collect that dividend yield, and then ride the bull market when it does come. And when it does come, your dividends go way up as well. So it's ideas and ways to play the commodity markets where you can basically get returns even if the commodity bull market isn't in cycle. I know the uranium guys are probably hurting because they don't have companies like that. Mainly speaking to coal companies, oil and gas, some of these energy service companies. Like there's a lot of companies that pay good dividend yields, or they're buying back shares and forcing their share prices higher by buying all that stuff back. And that's the options that companies have when you're a big cash flow generator and have infrastructure generating cash. So, keep that all in mind. I just look at these big picture charts. I do the big picture move. The symmetry determines my position size for the most part, and I ride it for the bull market. And that's why some people will call me a perma bull in commodities, but I'm not a perma bull if you've got patterns like this. Patterns like this determine my bullishness. Um, if I have to be a bull for 10 or 20 years and my returns are going to beat everything in the market, then that's what I have to be. The market made me who I am, and the market determines my decisions for the most part. I am a product of the market, and I am a student of it to try to incorporate whatever the market requires me to get the returns that I can try to get out of the market. So some people I know in comment section have said something on the lines like, "Oh, you missed the Nvidia bull market" or something, or they'll say something on the lines of that, which is true. I don't know that sector as well. And I also think that the risk reward, even buying it anywhere in these general areas, isn't nearly as attractive as buying stuff that is down like this and no one's in it. So, where the biggest pain can come from is chasing price. And if I miss out on an opportunity, or I miss out on a 150% move, that's okay, because the risk reward wasn't there to begin with. So that's the way that I view things, and I like seeing the huge symmetry and the low risk, and that's where I pile all my money. That's what I'll say there from an investor's standpoint.
Fantastic, Andy. I think this is a
Yeah.
message that every retail investor needs to hear. Um, we've been doing this for the last, I want to say, 4 to 5 episodes. So basically, at the end of each episode, I'll ask you to ask a question to my next guest. But first, you've got to answer the question from my previous guest. So I
Oh
had
no.
Adam Taggart on, and he wants to know.
Do you think we're going to have a recession in the next 12 months? And if not, what is going to keep us out of that?
So here is my opinion. I think we already went through or are in a recession.
Hmm.
It is being hidden by nominal terms. So what they're doing is they're printing a bunch of money from a nominal perspective, print, 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 fiscal spending. They are understating the inflation, and that money that they print goes into the top line of GDP calculations and the inflation on the bottom. So if you were to accurately record the inflation numbers, I think it would state that we are probably in a recession already. That's my guess. So we're already in a slowdown, like a real, in terms of real GDP, not this nominal terms. I think everything is being hidden nominally. So what they're doing is they're destroying the dollar, understating inflation and overstating GDP. So I think that we already had a slowdown. The better question is, can we get out of it, and what does it look like, and what financial assets benefit from that? When they hold interest rates steady, and they print a bunch of money, money gets directed in a slow economy towards like tech stocks. During a strong economy, it generally goes towards commodities and stuff like that. And that generally occurs under a real estate boom. So we're probably in a slowdown already, could potentially be called a recession. The naming of it doesn't really matter. And I think we're in it, and we're trying to come out of it. I think you can see that in the housing starts. You can see it in the slowdown in home sales. You can see it in all these different metrics. The unemployment rate, and we can do a quick unemployment rate here just to show
Yep.
you what that looks like. This is another thing that a lot of people use to gauge a potential recession, is the unemployment rate spikes higher, and we are coming up in unemployment rate. So I think the slowdown is there, and we could spike this upward, basically showing everyone that, yep, a slowdown is coming. And these are all slowdowns in the market. So it is definitely possible that a recession could be coming, and I'm not denying that it's not coming. And we may already be in it. We just don't know it yet. Because
Gotcha.
usually recessions aren't claimed till after they already have come.
And what is the question you want to ask my next guest?
Yeah, so I'm more on the investor. I'm on the investor side, and I want to find out ways of how to make money. So I don't know if your next guest. It would be nice to know what who your next guest might be,
I'll tell you,
because
but
I
I'm
could
going to edit
tailor
this.
it.
Yeah, I'm going to edit this part out, but it's Josh Young.
Yeah, so I would ask your next guest, what are some investment traits that have made you the most amount of money? What have you changed in your investment approach and style that has made you the most amount of money? And then conversely, what are some things that prevented you from making money the most? Like, what are some bad habits or traits that you have gotten rid of to really push your returns? So those are the two kind of big questions that I would have for your next guest.
Okay, sounds good. And one more thing before we sign off, I've got to ask you, is there a book or a series of books you'd recommend the average retail investor read, or people who watch this channel?
Well, a lot of the books that I have read, I've read Jesse Livermore, the Reminiscences of a Stock Operator. You'll get some things there. I think following Peter Lynch and Warren Buffett, there's a lot of good things that they can say. So One Up on Wall Street and stuff like that, books like that. You can read those, or read their quotes, read some of the writings of Buffett and some of his speeches. Listen to all of that stuff there. The reason I would choose them over maybe some other people is I think you need a little bit of technical analysis. That's the Reminiscences of a Stock Operator, Jesse Livermore. You'll kind of see how markets and how he did things, but I'm not stating that he's like, quote, the best trader, but this guy went broke like 3 or 4 times. So made a huge amount of money, went broke, made a huge amount of money. So that to me sounds like gambling. Warren Buffett and Peter Lynch, the reason I follow them is they never went broke. They just got rich and richer and richer. So I think adopting both strategies is could make you a much better investor. You take a long-term approach, you apply technical analysis on top of that long-term approach for your entry points, and then you adopt a lot of the holding strategies for what like Buffett and Lynch have for big long-term holding periods of these big, we'll call it paradigm shifts in the market of declining interest rates versus increasing interest rates and where you should be. So I think adopting both approaches is the best view, and knowing as much as you can. I'm not a trader. I used to trade a little bit. That's where I got my technical analysis from. But I've adopted definitely more a long-term approach. And to me, I've made a lot more money doing it. So I would study Lynch and Buffett.
Fantastic. So we'll have the link to those books down below. Be sure to check those books out. Andy, where can people find you?
Yeah, so I'm on YouTube as well. That's Finding Value Finance. I've got a website if you guys want to learn more about this investing, finding-value.com. And that's where I train people, teach people all this stuff, technical analysis, the cycles, what to look for if a recession is coming. Do you look at unemployment rate? Do you look at a yield curve? What does it all mean? And then I go and I dive really deep into potential investment opportunities. You can see what I'm doing, what I'm buying, what my portfolio is. I don't share my percentages because they change all the time in terms of my portfolio percentage holdings. You can ask me directly and I will tell you. But they change over time, so they fluctuate all over the place. But I go into individual companies. I do a lot of fractal analysis, which is patterns that repeat. And I look at the size of the patterns. I look at the balance sheet. and then I invest in those companies and share that with everybody. We've done pretty well. I started in 2022. I've got a lot of really good entry points for the members on there and myself, and pretty open and honest with everything. So you can ask me whatever you want. I'm never going to lie to anybody or do anything deceitful like that. And I'll show you the opportunities and what exactly I look for in setups.
Cool. Well, if you guys enjoyed this video, be sure to write "Go Andy Go" in the comments. Go Andy Go. Be sure to hit that subscribe button, you guys. Again, 87% of you guys who watch this content are not subscribed. So let's flip that ratio around. And also like the video. A like and a subscribe goes a long way. And with that, I shall bid you adieu. See you guys.